Even before getting to trade wars, South Korean GDP contracted in the first quarter of this year, which meant that output was down for the entire year leading up to tariffs. This was worse than was expected and has created a mini panic among South Korean officials who have haphazardly slapped together a massive bailout program, especially for the country's key industries. The Bank of Korea, the nation's central bank, is now near certain to lower its policy rates even more than had been anticipated. If, or rather when it does, it will become the next of the world's major central banks to race to the bottom. And BOK isn't that far from historic low territory already. And with the economy this week to begin with, ultra low rates are increasingly on the horizon there too. Jay Powell should be taking notes. Whether he likes it or not, this is the way the world was already traveling prior to whatever the tariff shock might add to this growing downside. And South Korea is a perfect example of it. The transition into and maybe out of forgot how to grow. And unfortunately, that transition isn't to soft landing and recovery. The fallout from the fragile economy being hit by the tariff shock is coming in already from other places. There is a report now that comes from China which says factory owners are dramatically cutting back on production schedules, furloughing workers, and in some extreme cases, temporarily closing entire facilities, if only to pause and assess the damage. So in response to the darkening global prospects, over in China, the PBOC offered the most one-year interbank loans since December of 2023, even though the central bank there has been trying to move away from this facility ever since then. The economy was already fragile to begin with, and now comes along the tariff shock. There's going to be global implications for all of this. And as I said, South Korea is the best example of both parts. On the one hand, the GDP figures completely confirm the fragile, forgot how to grow economy that's existing before we even get to trade wars. And on the other hand, this is the country that said exports are down in April already and down by a substantial amount. So you put those two things together and it has the government in Korea scrambling to piece together a massive bailout because they realize the implications locally and therefore internationally are going to be pretty severe. So South Korea already, you've got 4 quarters of basically nothing, which is an unofficial recession within an unofficial recession. And if GDP here in the first quarter of 2025 represents another inflection point, what you'd have is an unofficial recession within an unofficial recession that's already within an unofficial recession. And the South Korean government, in response to the data, knowing that it was coming, has pushed into extreme measures as far as fiscal response. So when the Bank of Korea meets next month, after holding its rates here in this past month, they're going to lower their growth forecast for 2025. The current forecast is for 1.5%, but that's nowhere near realistic, especially given what information we have right now. So the only real question for the Bank of Korea next month is how much lower they're going to reduce their forecast. And is it going to get down closer to 0, which is more realistic? They respond to weakness, they react to weakness by lowering interest rates. And the Bank of Korea started at 3.5% rates last year, with their first rate cut a little bit later than the other central banks in October, followed by one in November, which was the first back-to-back cuts from the Bank of Korea since 2008-2009. But by February, the Bank of Korea was back to cutting rates again. Then it held them last week. As I said, trying to blame uncertainty for the reason why they're basically paralyzed. And there's a possibility they're using uncertainty here. By they, I mean both the Bank of Korea as well as the Federal Reserve, and maybe even the Bank of England and some others too. They're using the term uncertainty because they didn't want it to appear to be too panicked by the financial fallout earlier this month. And that uncertainty really isn't about inflation uncertainty. It's really about financial uncertainty. Because either way, the overall economy gets weaker and weaker and weaker. So that raises the chances of another major central bank reaching historic lows already just in the near-term future in Korea, and maybe even going beyond that into ultra lows if the economy continues to develop in the same way that it has over the last year, with an acceleration to the downside, that second inflection after the inflection last March and April. And with all of this going on, with GDP basically confirming and then trade war prospects, the trade war shock potentially on top of it, what the Korean government said was more than 4 trillion won will be invested to respond to rapidly changing trade conditions and to enhance competitiveness in high-tech industries. Over 25 trillion won in policy financing will be provided to support companies facing tariff-related damages or export crises. And the number of companies receiving export voucher support will also be more than doubled. Fiscal support for infrastructure, finance, and R&D in advanced industries such as AI and semiconductors will be expanded by over 2 trillion won. Furthermore, over 4 trillion won will be provided to support small business owners and vulnerable groups. A new, quote, burden relief credit program will be introduced, offering 500,000 won per year to small business owners to help cover utility payments and insurance premiums, which reimburses a portion of the year-on-year increase in credit card spending in the form of Onuru gift certificates for business with annual sales of 3 billion won or less, so basically small business bailout. Policy financing to support the livelihood stability of low-income youth and individuals with the lowest credit ratings will also be raised by 200 billion won. So like I said, they're acting quite panicky because they realize, like the Chinese and everyone else, there's some real downside potential here. Fragile economy meets a tariff shock means panicky government responses. And we're already seeing the spillovers, not just South Korea. South Korea, in many ways, is a proxy for the Chinese economy, which is a proxy for the global economy. It all fits together. But South Korea is the fourth largest economy. Its biggest trading partner is China. And a report that came out yesterday from the Financial Times shows there's already major implications, negative implications from the tariff shock and the fragile economy. What the FT said was factories in China have begun slowing production and furloughing some workers as the trade war unleashed by President Donald Trump dries up orders for products ranging from jeans to home appliances. With most Chinese goods now facing U.S. duties of at least 145%, some factory owners say American customers have canceled or suspended orders, forcing them to cut production. Workers said that the trade war had prompted the suspension of production for a week or more at plants making products ranging from shoe soles to jeans, electrical outlets, and portable stoves. Some factory owners said they were cutting overtime or even weekend work. Wang Xin, who's the head of the Shenzhen Cross-Border E-Commerce Association, which is an industry group representing Chinese merchants, said that many of them were extremely anxious and had told factories and suppliers to halt or delay deliveries. And this prompted some factories to suspend production for 1 to 2 weeks. So already fallout in the Chinese system, which you would expect given everything that's been happening. Global demand hasn't been strong to begin with, and now all this uncertainty over tariffs, as well as the tariffs themselves, of course the Chinese were going to suffer a major setback. As far as the Chinese government response to the growing downside inflection, the PBOC injected a pretty substantial amount through its one-year medium-term lending facility, or MLF. According to the central bank itself, yesterday they offered a total of 600 billion yuan at the medium-term lending facility, which is the equivalent of about $80 billion worth, which, given that there's only 100 billion yuan expiring, that means a net increase or net auction for the MLF at 500 billion yuan, which is the most the PBOC has offered through the MLF since December of 2023. And this was not expected at all. Instead, the PBOC has been using shorter dated reverse repos, and there are a lot of those coming due, but now they come along, go back to the MLF, which indicates the Chinese government, Chinese central bank in any way, is looking at everything that's unfolding and thinking we need to be very proactive about how we approach the fallout from this latest shock in the global economy. They've been holding them steady largely because the banking sector doesn't want lower benchmark interest rates because that would mean lower profitability for banks that can't really afford it. So they have left the loan prime rates on hold for the last 6 months. Instead, the PBOC is turning to these other liquidity tactics, or what are supposed to be liquidity tactics, leading up to now. Again, the fragile situation before we even get there. And now with long-term bond rates that are continuing to sink lower and lower back toward the record lows, even though the Chinese government is selling more and more bonds, tells you that the Chinese bond market looks at the current situation, that this is all, the entire world economy, the entire system is heading in the wrong direction, and nothing is changing that, at least for the better. There's no soft landing here from the Chinese perspective, which flows through the South Korean perspective, which flows into all of the rest of Asia and beyond. So South Korea, another really good example of forgot how to grow even before we get to 2024. And then they forgot even more how to grow in 2024, even before we get to tariffs in 2025. So we're starting to see how the trade war shock fits into the forgot how to grow economy, what's actually happening in the opening stages of what looks increasingly likely the next stage in it. The government in Korea is not sanguine about prospects, nor is the BOK, the Bank of Korea, likely to hold up on this uncertainty paralysis that it's portraying. And the reason why, look at what's happening in China. At least these initial reports from the Financial Times and a couple other sources are pretty darn concerning. We don't know yet how widespread these factory furloughs and canceled orders might be, or how long it might last, if maybe this is only a temporary adjustment. But when you're picturing in your mind how an economy transitions from forgot how to grow to remember how to recession, this is exactly what it looks like, especially in these two key places, South Korea and China. This is what you would expect to happen if this was happening. For the marketplace, for interest rates, it's all been pretty simple from the very beginning. Interest rates that go down and they stay there. And if interest rates are going to go down and they are going to stay there, this is exactly what it would look like on the way to that outcome.